Okay, so now we shall go ahead and take on one more example on stock buyback. And this question appeared in May 23 examination. Here we go with the question. Yes.
High Growth Limited was having an excellent growth over a number of years. The board of directors is considering a proposal to reward its shareholders by buying back 20% shares at a premium. The premium is to be paid by raising a loan from the bank. The interest on loan is to be serviced by internal accruals as apported by the financials of its HGL. The company has a market capitalization of 15,000 crore rupee and current earnings per share is 600 rupee with a price earnings ratio of 25 times.
Yeah, guys, listen over here. They are given the market capitalization, which is nothing but the number of shares in issue, that is shares outstanding, that into the price per share on that date is rupees 15,000 crore. Now they given the data for you to calculate the current market price of a share, because they given the earnings per share to be rupees 600, and also they given the price earnings ratio to be 25 times. Now you all know that price earnings ratio times, that is into EPS, will give you the market price per share. Now that is 25 times rupees 600, that is 25 into 600, how much you get? 15,000 rupees will be the price per share, that is supposed to be the current market price. Is that fine?
Yes, sir.
Now, if I divide 15,000 crore, which is the market cap, that is the number of shares into the price per share is 15,000 crore. Now, if I divide that by that 15,000 crore rupees by the market price per share 15,000 rupees per share, I'll get the number of shares in issue, which is what? 1 crore. Yes?
Yes.
That is shares outstanding as on that date when the company is going to make an offer for buyback. Is that clear? On the offer date, your company shares are trading at 15,000 rupees and there are 1 crore shares in issue, that is outstanding on the balance sheet. Next.
Yes, sir. The board expects a post-buyback market price per share of rupees 10,000.
It is given that rupees 10,000 will be the post-buyback price. That is after buyback, the price per share will become how much? Rupees 10,000 from 15,000 rupees. It will come down to rupees 10,000. Next.
The price earnings ratio post-buyback will remain the same.
It is given that the price earnings ratio will be the same. That means what? 25 times. And you all know that price earnings ratio is nothing but market price per share divided by EPS. Or if I am given the price earnings ratio to be 25 times, which is equal to 10,000 rupees market price divided by EPS, I don't know the post buyback EPS, I can find out, yes or no?
Yes.
If I divide 10,000 rupees by 25, I will get the post buyback EPS will be rupees 400. Is that fine?
Yes, sir.
From rupees 600 per share come down to rupees 400 per share. Next.
The loan can be availed at an interest rate of 16% per annum.
It is given that your company is going to borrow money for the purpose of buyback, right? It is given the loan will be borrowed at an interest rate of 16%. Suppose the loan amount is L or X. That into 16 by 100 will give you the amount of interest you're going to pay on the loan that will be borrowed for the purpose of buyback. Is that fine? You're going to use the loan funds to buy back. Next.
Applicable corporate tax rate is 30%.
It is given tax rate as 30%. And also given earlier the company wants to buy back 20% of its shares, right? What is 1 crore shares into 20%? Your company wants to buy back 20 lakh shares in the market. But here the buyback price is not given in the question. How do you find that? You got to find how much a loan your company wants to borrow, and that will determine the buyback price. Because you want to buy 20 lakh shares by taking a loan, right?
Yes.
Yes.
So you are required to calculate, number one, the interest amount which can be paid for availing the bank loan.
What is the amount of interest you can afford to pay? Got it?
Yes, sir.
That is for the purpose, a loan to be borrowed for the purpose of buyback. Number two.
Number two, the loan amount to be raised.
The loan amount to be raised.
And number three, buyback premium per share.
Okay, 3 questions. Okay. Now take this. Please refer to the solution. We know that rupees 600 is earnings per share before buyback. We also know the price earnings ratio is 25 times.
Yes, sir.
From our discussion, remember 25 times rupees 600 gives you 15,000 rupees per share, the price, the market price per share. Now divide 15,000 crore by 15,000 rupees per share will give you what? 1 crore shares will be bought, or will be, that is shares outstanding, sorry, okay?
Yes, sir.
Of these 1 crore shares, you want to buy back 20%.
20%.
Which will be 20 lakh shares, leaving a balance of 80 lakh shares after buyback. Yes,
Yes, sir.
in the hands of the shareholders. Now, what will be the post buyback earnings per share? Remember, it is divide 10,000 rupees by 25 times will give you rupees 400 per share.
Share.
Now, my task will be to calculate the earnings after tax, the profits available to equity shareholders
Yes, sir.
after paying 30% tax before buyback and after
After
buyback.
buyback.
Before buyback, very simple. There are 1 crore shares outstanding, right? And the earnings per share is rupees 600
Yes, sir.
given. Now we know that what is earnings per share formula? I take the profit after tax available to equity shareholders divided by 1 crore shares is equal to rupees 600. Or I can take 1 crore shares outstanding into rupees 600. How much I get? 600 crore is your post-tax earnings, PAT, before buyback. Yes or no?
Yes.
But how do you find the pre-tax profits? Very simple. It is given the tax rate is how much?
It is
30%.
30%.
That means what? This 600 crore represents 70%, the balance. If the tax rate is 30%, what is the meaning? Suppose your company earns rupees 100 pre-tax profits. On that 30% tax will be rupees 30 tax gone. The government takes a bite. Okay, the tax goes away, leaving a balance of rupees 70 in your hands. Yes or no?
Yes, sir.
Therefore, 600 crore represents 70%. What is for? 100.
100%.
That is what is captured in that working. 600 crore
Divided by 1.
divided by
minus
1 minus 0.3. It is as good as rupees 600 crore into 100 by 70, which gives you 857.29 crore rupees will be a pre-tax profits. Yes?
Yes, sir.
Before buyback. How to find the pre-tax profit post buyback? We know rupees 400 is the earnings per share. And that into 80 lakh shares outstanding. That is post buyback.
Yes, sir.
That gives an amount of rupees 320 crore as your post-tax profits of PAT after buyback. How do you find the pre-tax profit after buyback? Take 320 crore, divide by 70 into 100, or divided by 0.7. How much you get?
457.1429 crore.
Please remember, the pre-tax profit, PBT, is 857.1429 crore before buyback. After buyback, it can come down to how much? 457.1429 crore. That means your profits can come down by rupees how much? 400 crore. very clearly given in the question that the company will pay interest on the loan out of its internal accruals. That means what? Out of profits. Got it? Therefore, your profits can come down to, if your pre-tax profits are 857.1429 crore, it can come down to 457.1429 crore. That means your company can afford to pay how much interest on the loan? 400 crores. Yes or no? That is the amount of interest a company can afford to pay. Remember, your PBT, profit before tax. Okay? Let's assume your company is right now unlevered. No interest at all. So your PBIT also is how much? It is 857.1429 crore, right?
Yes.
That amount can come down to 457.1429 crore after you pay interest on the loan borrowed for the purpose of buyback. Is that clear? So 400 crore is the interest you can afford to pay. That is the answer to the first question, right?
Yes, sir.
How much interest you can pay? 400 crore. That is the first question answered. We also know that you have been asked about the loan amount.
Yeah.
You know the loan amount. Loan amount is, say, let us say XL. Okay, loan amount into 16 by 100, the rate of interest is equal to how much?
400.
400 crore. Or loan will be 400 crore into 100 by 16, or as good as divided by 0.16. Yes or no? So your company can borrow rupees 2,500 crore for the purpose of buyback. Yes or no? Rupees 2,500
500
crore you can buy. That is, you can borrow for the purpose of buyback. Got it? That is the amount of loan you can borrow. Now you cross check also. What is 2,500 crore loan into 16% interest will give you rupees 400 crore. Understood?
Yes, sir.
Now tell me, this is the amount you want to borrow for the purpose of buyback. And how many shares you want to buy back? 20 lakh. Now divide rupees 2,500 crore. That's crore, okay? Divide that by 20 lakh shares. 20 lakh.
Yes, sir.
Which is 0.2 crore shares. Got it? If you divide rupees 2,500 crore by 20 lakh shares, you'll get a buyback price of rupees 12,500 per share. But now there is a flaw in the question. You have been asked to calculate the buyback premium. Remember, buyback premium means
Yes, sir.
it is nothing but it is a premium, the buyback price in excess of the market price of the company shares when the offer is made for buyback. Got it?
Yes, sir.
Example, TCS. When they bought the shares, that is on October 11th, 2023, they made an offer for buyback.
Yes, sir.
Now they offered a buyback price of 4,150 rupees, which was a 15% premium to the closing price on 11th October. Got it?
Sir.
Basically, you are supposed to compare 12,500 with 15,000 rupees. This is where people got bamboozled in the exam. They were stunned. They it's in fact is below the market price, not above. But remember, generally in the real world, the buyback price offered will be higher than the market price. If you're going to offer something less than market price, there is no incentive for the shareholders to offer their shares to the company. Got it?
Yes, sir.
Yes. So, please remember, but here what he has done is, he has found the buyback premium by comparing 12,500 buyback price with the post buyback market price. How much? 10,000 rupees. And the answer given is 2,500 rupees is a premium per share on buyback. Got it?
Yes, sir.
But which is not the right answer. In fact, the buyback price is rupees 2,500 less than the current market price. Got it?
Yes, sir.
But just to be with the answer, you can say it's 2,500 premium. But the truth is, people can check the news article on TCS buyback in the year 2023. It says very clearly the company offered a buyback price of 4,150 rupees, which is a 15% premium on the closing price as on 11th October 2023. Is that fine?
Yes, sir.
Got it?
Yes, sir.
So guys, that is all with this example. Please go ahead and jot down the solution in your notebook. And with that, we complete this topic on rights, bonus and buyback.
Yes, sir.